$300 billion. That is how much the software industry lost in market value this week. Not because earnings collapsed, not because a recession hit, because AI stopped being a feature on a slide deck and started replacing the software itself. The Dow crossed 50,000 for the first time. Inflation fell to its lowest level in 8 months, and value stocks just posted their widest gap over growth since early 2022. This is your weekly market and value-aligned portfolio review for the week ending February 14, 2026. Let me walk you through what happened, what it means, and what we are doing about it. If we haven't met, I'm Berk's AI avatar. I deliver financial content for free so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Here is what we are covering today: the massive rotation from software into physical infrastructure, the SaaS sell-off and what triggered it, inflation and jobs data that moved the Fed conversation, how the value-aligned portfolio performed, including 3 holdings that dropped double digits, and 3 things that actually matter for your long-term wealth. Stay through the end. The last section ties all of this together. The S&P 500 finished flat for the year to date. That headline hides what actually happened underneath. Software stocks had their worst stretch since the pandemic sell-off. The Dow punched above 50,000 for the first time in history. And the catalyst was not a recession or an earnings miss. The catalyst was AI moving from concept to replacement. Anthropic's Claude legal modules went live. Altruist launched an AI-powered tax planning tool, and the market had to confront a question it had been avoiding. What happens when the AI agent replaces the software it runs on? The VAP declined 2.05% against the S&P 500's 1.35% decline. $300 billion in software market cap, gone. The Dow hit a milestone, and the rotation from bits to atoms accelerated. Look at this chart. The Dow gained 2.5%. The Nasdaq dropped 1.8%. That 4.3 percentage point spread is one of the widest weekly gaps between these two indexes in years. Value stocks widened their year-to-date lead over growth by 4.2 points. That kind of spread has not shown up with this consistency since early 2022. The equal weight S&P 500 outperformed its cap-weighted sibling by 75 basis points. That tells you something specific. The average stock in the index is doing better than the index itself. Breadth is expanding even as the megacaps lose altitude. For long-term owners, that is the more important signal. I call this atoms over bits. The money is moving from things that live as code on a screen to things that exist in the physical world. Energy gained 3.2% this week. AI data centers need power. Oil pushed above its 40-week moving average. The sector is up 14.3% year to date. Materials rose 2.8%. Copper is rallying. Infrastructure spending is real. The sector is up 8.6% for the year. Industrials climbed 2.1%. Strong jobs data, reshoring capital expenditures, up 7.6% year to date. Technology fell 2.4%. The SaaS crash and AI replacement fears dragged the sector down 2% for the year. The 5.6-point spread between the best sector and the worst tells you everything about the current market. Investors are buying oil wells, copper mines, factory floors, and hospital beds. They are selling code. Now, the big story. The single most consequential shift of this week, and possibly this quarter. The software sector entered bear market territory. The iShares Software ETF, ticker IGV, is down 30% from its highs, down 20% year to date. Forward price to earnings ratios collapsed from 39 times to 21 times. That is the lowest level since the mid-2010s. Three catalysts hit in 1 week, February 2nd and 3rd. Anthropic released Claude legal modules, AI-driven contract review, NDA triage, compliance workflows. Thomson Reuters dropped 16% in a single session. LegalZoom lost 20%. The combined market cap destruction across legal tech names exceeded $100 billion in 2 days. February 5th, Claude Opus 4.6 launched. Enhanced financial research, coding, analytics. The vibe coding phenomenon meant non-developers could build functional applications using plain language. Salesforce fell 11%. Microsoft shed $360 billion in market value in 1 day. February 10th, Altruist launched Hazel, an AI tax planning tool. It reads 1040s, pay stubs, account statements, meeting notes, and generates personalized tax strategies. Work that took a human advisor hours now completes in minutes. LPL Financial dropped 8.3%. Schwab dropped 7.4%. Raymond James fell 8.8%. The market is no longer pricing AI as a feature that helps existing software. The market is pricing AI as a replacement for existing software and the humans who operate it. Seat-based subscription pricing, the business model that built a $3 trillion software industry, faces an existential question. Every single top gainer this week makes or moves something physical. Vistra Corp gained 14.8%. AI data centers need electricity. Vistra supplies it. Shares hit $178, up 28.5% year to date. Constellation Energy rose 12.3%. Nuclear power is having a renaissance because AI needs baseload power that does not depend on weather. The stock hit $312, up 22% for the year. Nucor gained 8.2%. Steel demand from reshoring and factory construction pushed shares to $165. The market is telling you where value creation is migrating. The companies building the physical infrastructure for AI are winning. The companies whose software AI is replacing are losing. Underneath the AI drama, the economic data this week was genuinely encouraging. January CPI came in at 2.4% year over year. That is the slowest pace since May 2025 and an 8-month low. Core CPI at 2.5% was the lowest reading since March 2021. Shelter costs, the stickiest piece of inflation, finally showed meaningful deceleration. The jobs report was strong. Non-farm payrolls added 130,000 positions, more than doubling December's revised 48,000 figure. The unemployment rate dipped to 4.3%. Consumer sentiment jumped to 57.3, a 6-month high. What does this mean for the Fed? The inflation data gives them room to cut rates later this year. But the strong jobs report means they are not in a hurry. Expect patience through at least mid-year. 3 things from the global picture. The European Central Bank held rates at 2% for the 5th straight meeting. Eurozone inflation is at 1.7%, below target. European software stocks mirrored the US sell-off. China launched a wave of new AI models aimed at rivaling American offerings. That intensified competitive pressure on US software companies and created demand uncertainty for semiconductors. Commodities rallied hard. Crude oil climbed 6.8% to $79.42, back above its 40-week moving average. Natural gas surged 20.6%. The Bloomberg Commodity Index is up 10.4% year to date. That supports the atoms over bits rotation. Markets are closed Monday for President's Day. The shortened week still carries critical catalysts. Tuesday, Palo Alto Networks reports. That is the cybersecurity earnings test. Wednesday, Copart and Occidental Petroleum report. Copart is a VAP holding, and we will be watching closely. Thursday, Walmart. This is the single most important consumer spending read of the week. Walmart sees everything. Friday, the core PCE price index, the Fed's preferred inflation gauge, and a GDP update. If core PCE confirms what the CPI just told us, rate cut expectations will move. Quick note before we get to the portfolio section. If you are serious about compounding your retirement wealth for the long term, finding companies that double their share price every 3 to 5 years and understanding why investing in shares of great businesses with aligned management teams lowers monitoring costs and allows for long holding periods. We built a free 401k review specifically for people in that situation. No sales pitch. We look at your current fund choices and show you where the fees are hiding. The link is in the description and the pinned comment. Only for people who are serious about this. Now, the portfolio. The value-aligned portfolio declined 2.05% this week versus the S&P 500's 1.35% decline. Year to date, the portfolio sits at negative 1.25% versus the index's flat return. I am not going to sugarcoat that. We underperformed. The 125 basis point year-to-date gap comes from 3 concentrated earnings-related declines. Medpace fell 21%. Roper Technologies fell 11.3%. Kinsale Capital fell 10.3%. Strip out those 3 names, and the rest of the portfolio roughly matched the index. That is the nature of concentrated, high-conviction portfolios. When 3 holdings absorb double-digit declines in the same week, the math is punishing. The question that matters is not whether the stocks went down. The question is whether these declines reflect permanent damage or temporary repricing. The winners this week tell the same story as the broader market. NXP Semiconductors gained nearly 9%. The automotive chip cycle is recovering, and AI infrastructure demand is pulling the entire semiconductor supply chain higher. Every car sold today has over $500 in chip content. By 2030, that number exceeds $1,000. ServiceNow rose 6.3%, a notable countermove against the software sell-off after its 9th consecutive earnings beat. ServiceNow's platform sits between AI outputs and human decisions. It is a coordination layer, not a replacement target. Taiwan Semiconductor added 5%. Every AI agent needs TSMC silicon, full stop. AutoZone gained 4.8%. Cars break down, parts wear out. AI cannot install a brake pad. This is the anti-software stock. Installed building products rose 4.6% and hit new 52-week highs. You cannot insulate a house with an AI agent. Now the hard part. 3 holdings that took real damage this week. Medpace fell 21%. The company beat on both revenue and earnings. The sell-off was about Q4 clinical trial cancellations hitting their highest level in over a year, concentrated in the metabolic drug segment. Growth guidance decelerated to 9 to 13%. A 21% decline for a company that just beat earnings and holds a $3 billion backlog likely overshoots the fundamental impact. Painful, but not thesis-breaking. We are watching the April earnings report for cancellation trend normalization. Roper Technologies fell 11.3% and hit a 52-week low. This one is the most troubling. Deltek bookings fell double digits. The freight cycle is weak, AI software repricing hit their vertical software businesses. The stock is down 46% from its highs. But a board member bought $500,000 worth of stock near the lows this month. We are watching the April 27 update closely. Kinsale Capital dropped 10.3% despite beating on both lines. Heightened competition in commercial property and questions about catastrophe exposure from their homeowners expansion caused the sell-off. But the combined ratio was 74.9%. The expense ratio advantage is structural. Consensus price targets sit near $499, which implies 23 to 34% upside from Friday's close. This is an overreaction. Three things that matter most from this week. Number one, AI has moved from concept to disruption. Claude's modules and Altruist's Hazel forced a $285 to $300 billion software repricing. The market is no longer asking, will AI disrupt SaaS? It is asking, how fast? Winners, AI infrastructure. Losers, seat-based SaaS. Number two, inflation is fading, but the Fed is patient. January CPI at 2.4%, core at 2.5% was the best print in months. But 130,000 new jobs means the Fed is not in a hurry. Expect patience through mid-year. Number three, value is beating growth, and the rotation may just be starting. Value outperformed growth by 4.2 points in 1 week. Equal weight beat cap-weighted. Breadth is expanding. This kind of rotation can persist for quarters, not weeks, when the catalyst is structural. Holdings dropped double digits. The temptation to do something is real. But consider this. The businesses in this portfolio generated billions in revenue this week. They served millions of customers. They ran thousands of clinical trials. They underwrote thousands of insurance policies. They fabricated billions of transistors. None of that stopped because a stock price went down. Stock prices measure sentiment. Business performance measures value. Over any meaningful time horizon, 3 years, 5 years, 10 years, value wins. Your job as an owner is to stay patient, stay disciplined, and stay aligned with what the businesses are actually doing, not what the market thinks about them this week. If this video helped you see past the noise, you will want to watch this one next, where I break down the 3 types of companies we own and why we believe concentrated portfolios built around owner-aligned businesses outperform over time. That video is right here.